Okay, right. I think we're on, just gone past, so I think we'll start now. We've got a number of attendees online. So firstly, I'd just like to welcome everybody for joining us today on our webinar. Some of you will have been on our webinars before, and we do run a series every few months where we look to be joined by some of the underlying fund managers and experts in the industry, discuss all things crypto, specific events in the market, or need be just to educate our network and our interested parties and investors on all things crypto. Before I do so, I'd just like to briefly introduce myself, Kevin Ballard. I am a co-founder of Block Asset Management, and Block Asset Management are a Luxembourg domiciled crypto specialist alternative investment fund manager. That was a mouthful. We manage the world's first blockchain and crypto assets fund of funds. As a fund of funds, we invest into multiple fund managers that pass the most stringent of due diligence. And I am very pleased to be joined on the webinar today by 3 such managers. Before I go any further, could I ask the 3 managers to introduce themselves? And can we start with Desiree?
Hi everyone, my name is Desiree Feloyo. My background is traditional finance. I used to work as a portfolio manager on European equity funds, and a bit more than 3 years ago we launched Swiss Rex Crypto Fund. That's an actively managed crypto fund, and the strategy is based on fundamental research.
Excellent. And going from my screen right to left, I have next Michael.
I'm Michael Bicella, one of the partners at Block Tower Capital. I, similar to Desiree, have a traditional background, spent 10 years at Goldman Sachs, the bulk of which was in a cross-asset capacity on the trading desk. And we started Block Tower Capital back in 2017.
Excellent. And last, but by no means least, Jeff, please introduce yourself.
Sure, thank you. I'm Jeff Dorman. I'm the Chief Investment Officer and one of the founders of ARCA, which is a full-service asset management firm out of Los Angeles and New York dedicated to digital assets. Like the rest of the panel here, came from the traditional world. I was an investment banker at Lehman Brothers, a credit trader at Merrill Lynch, and a portfolio manager and trader at Citadel and a couple other smaller hedge funds.
Excellent. So I'm sure everyone will agree it's a fantastic panel that we've got with us today. I'm going to jump straight in with the obvious question, and a question that we're inundated with on an almost daily basis. The elephant in the room, the crypto, the retracement that we've seen in recent weeks or months. You know, we've seen a somewhat almost 50% correction in the market, I guess, over the last couple of months. Why do we think this is? Are there any specific events, or why are we finding ourselves in the situation that we are, given just how bullish everything was just 2 months ago? So could I start with Desiree? Do you have any thoughts on that?
Actually, our fair value for Bitcoin at the beginning of the year was $20,000 US, and the actual price was already at the 100% overvaluation at the beginning of the year. And this was the reason for us why we had exposure. We increased our market neutral arbitrage position in the portfolio, and there we made quite nice gains. So for us, it was a clear overvaluation. There is always a certain trigger. This time it was interest rates that increased, and gold was caught, and later on the crypto market fell. And therefore, I think it was the normal correction.
Michael, do you want to add anything to Desiree's comments?
Yeah, I mean, we were in a parabolic market. I think for us, we definitely, and excuse me for any background noise, I think there's a landscaper behind me currently. But we were in a parabolic market. We take a lot of information from quantitative data points, on-chain data, primarily off-chain data though, where we were in a much healthier regime in the earlier part of the year, through the kind of halfway through the first quarter. Leverage crept into the system, both in traditional formats and in perpetuals and futures, but also in the DeFi space. And so, things don't go one way forever. I think you have to take direction from the market in this space, but you also, as risk incrementally increases within the market, it's sort of proper risk management to reduce your overall exposure. So, I think while no one can actually, peg the market 100% accurately, I think as inherent risk entered the market, it was prudent to be trimming. You had a few things that came about that, some of the larger holders of Bitcoin or buyers of Bitcoin in 4Q and 1Q sold down their positions. You had folks out in the UK, and like Ruffer, for example, who, whether it be a trade or board of director issues, had to sell down their stake. You had Chinese mining obviously come offline, and that, I think required a lot of financing from those particular inventories that were selling off. And so obviously hindsight bias is 2020, but there were a lot of things in hindsight that kind of indicated, outside of the excess leverage, that markets were in for a bit of a pullback.
Okay, Jeff?
Yeah, I think I have more questions than answers after what Desiree said, including how she gets to a fair value for something like Bitcoin, and also that if interest rates were the reason, well, why aren't we screaming higher than now that the 10-year is back to 129? But anyway, I would say, I don't have an opinion on Bitcoin per se. I think Bitcoin is and always will be a perpetual call option, which basically means it's either worth zero or it's worth probably $1 million per token, and literally everything in between those values is just noise. And it's fun to trade, but there's not a whole lot of sense that can be made out of it. You have a lot of narratives that push it higher in the first part of the year, like Elon Musk and Tesla buying, and other corporations like MicroStrategy. And then you had a lot of obviously incredibly negative news, from the ESG news to China. But I don't focus much on Bitcoin. I think the rest of the market outside of Bitcoin, which is your protocols and platforms, your gaming, sports, NFTs, DeFi, I don't see any reason why we should have sold off at all, other than exuberance being popped a little bit. I mean, fundamentally, everything looks as good or better than we've ever seen. I mean, we're involved in gaming companies that are having all-time high revenues. DeFi, volumes came off a very high May, but second quarter was the highest quarter by 100% in history in terms of volumes and in terms of assets under management. And even June, which was down 43% from May, was still the third highest month ever across all of DeFi. So we're not seeing it. I actually wrote an article 2 weeks ago debunking all of the bear theses. Everything from the China situation. Okay, that's temporary. To massive regulatory pressure from the U.S. I don't know how many people on the call right now live in the U.S., but regulation doesn't happen quickly here. We're 2 to 3 years away. This is not El Salvador, where a bill is going to get passed in 3 days. So, that's not real. From the Fed tapering, I think the rates market is telling you, right? The Fed's not tapering anytime soon. To retail momentum being dead. I mean, I'm still getting texted 43 times a week from high school and college friends talking about digital assets. So you go down the list. I don't see why anybody is talking about a bear market other than people convincing you that it's a bear market. So we took a lot of profits ahead of the sell-off just because there were signs that it was overheated. But I'd be shocked if we're not up, several, at least 100% from here across most of the market, not including Bitcoin, over the next 3 to 6 months.
That's the view that we definitely share. And some of your comments have led me into the next question, really. A lot of comments that we've had surround the fact that, every day there seems to be another story of an institution or a company. And you mentioned yourself, Michael Saylor, MicroStrategy, whether it be Square, PayPal. All these institutional investors are now adding Bitcoin to the balance sheet or advocating the investment into digital assets. Then we read, papers coming out from JP Morgan, Morgan Stanley, Goldman Sachs, UBS, Wells Fargo, but the list is almost endless, that are all discussing now, giving their clients the option of investing into digital assets, or being very vocal to the asset class and being open to digital assets as an asset class now, whereas a year ago those doors were closed. So if we've got an asset class that has a limited supply, or we have tokens with a limited supply, but it appears these institutions are now buying and demand is pent up, why are we seeing the price fall so heavily?
Yeah, I'll jump in and I'll address the first point and then the second point. I'm sure Jeff and Desiree as well have spoken with every head of both the high net worth channels and the institutional channels of every single investment bank platform that currently is out there, because they're all looking at the space. And that's the tip of the iceberg, right? So you have, people launching Bitcoin funds and then thinking incrementally about VC and hedge funds. And then that's the tip of the iceberg in most organizations, where you have, things like Link being built at JP Morgan with Christine Moore. You have, Goldman Sachs literally just got approval to double their headcount of the digital assets group. So they're going to go from 20 to 40 people. They're doing things like issuing corporate debt on the Ethereum blockchain. They're doing hybrid digital IPOs. They're doing blockchain settlement on this, in their swaps business, a reduction of operation costs. And they're also testing the waters. I should say they're doing a lot of diligence. Shouldn't say testing the waters because that's false, but doing a lot of diligence on the DeFi space and what that looks like. And that's probably 5 to 10 years out before they deploy balance sheet capital. But they are doing a lot of things and are deploying more human and financial capital behind it. And I'm sure that's across the board. I'm closer to that group particularly. And you know, I would say that is indicative of what Jeff discussed, which is short cycle market movements versus long cycle adoption. And if you think about the demand side of the equation, demand hasn't retreated from anyone but arbitrary day traders, right? So you have a bunch of prop desks and they've kind of peeled out, and their leverage reduction has overly impacted the market alongside some other large sellers. But the demand is still there. The long-term demand cycle is still there. And the supply, as you mentioned, I know Jeff doesn't want to talk about Bitcoin, but in Bitcoin's case, supply is fixed. And the reality is things are happening beyond just a fixed supply in the Bitcoin code, which are borrowing against Bitcoin. So you have Silvergate Bank that's building up a large business around using Bitcoin as collateral for loans. That, for many organizations and individuals, becomes a massive velocity sink for supply in the industry. So you don't necessarily need to sell your Bitcoin to finance other things. You can just use it as collateral to borrow against it at relatively nice rates, given the yield environment, but also just the desire to lend against Bitcoin currently.
To be fair, it's not that I don't want to talk about Bitcoin. I don't have anything new to talk about with Bitcoin. It's been the same story. The same story for 10 years, right? I'd go further on that though, and just say, Bitcoin is a $600 billion asset. There's only 7 global equities that are larger than 600 billion, right? I mean, how many other equities would you say, hey, well, how come this isn't higher by 40% because one new buyer came in, right? I mean, it's not practical. You're not going to move a $600 billion asset by 20 or 30% just because of a headline or because of a new player. Now, to Mike's point, I agree. There is a lot of infrastructure that has been laid over the last 3 years. There's a lot of new interest in Bitcoin that has been coming from traditional Wall Street, but it's going to take a long time for the majority of the assets in the world to get into the space. Also, don't forget, if Bitcoin's best comparison is gold, how many people talk about gold 24/7, right? Nobody cares. Not that many advisors care about gold. Not that many, traditional Wall Street, broker dealers care that much about gold. It's very possible that they bypass Bitcoin into other assets, and we're seeing it now. We're seeing anecdotal evidence for the first time ever that a lot of the OTC desks are getting new entrants to this space that aren't going through Bitcoin first. They're going directly into Ethereum or directly into DeFi. There's a gaming company called Axie Infinity that has done $25 million of revenue this month alone. And they are getting buyers from Brazil of Axie Infinity tokens that have never bought Bitcoin or Ethereum before. Now that's very anecdotal, but I think that's probably more of the norm going forward, right? This is not a single asset class. And different buyers have different interests. So this uniform focus on Bitcoin and every headline around Bitcoin, it's very likely that Bitcoin is a tremendous asset. I mentioned earlier, I think it's a binary option. I'm on the camp that it will go to $1 million a token probably eventually, but it's not going to get there anytime soon, and not certainly because of 1 or 2 new buyers. I think the rest of this asset class is going to disproportionately benefit, and you're seeing it this year, right? Bitcoin is the worst performing digital asset of every digital asset that we track. So, I think that's the norm going forward.
So in terms
of... We've covered a lot there. Would you have any comments?
Yeah, I think lots of these big buyers also already started to sell parts of their positions when they communicated that they had bought some Bitcoins, for example, Tesla. And when I look at our investor base in the fund, we have a lot of family offices and asset management companies that only now start buying. So far, it was mainly high net worth individuals that were invested in such funds as ours. We have a couple of fund of funds, but banks are actually just talking about it so far. I mean, we are also in contact with many banks. They don't offer anything to their clients yet. Actually, our fund cannot even be bought with Credit Suisse or UBS because it's a crypto fund. So I think there is a lot of talking, but not much has happened yet. And when we talk about pension monies, there is nothing happening there yet so far. So I think there is still a lot of talking and a lot of potential for buyers.
Yeah, we're seeing the same. There's definitely a lot of money sat on the sidelines still, waiting for a final sign off, or waiting for some form of legislation or some form of corporate governance agreement to let them dip a toe in the water, if you like. And we've got an awful lot of family officers, or more so private banks and broker dealers that at the moment haven't quite got the sign off to move forward, but they're monitoring the space very, very closely. And as Jeff said, people are discussing it on a daily basis. It's there. It's right on the tip of their tongue. They're closely monitoring the digital asset space, and hopefully it's just a matter of time before they can progress forward and invest. So, hopefully we'll get by those hurdles soon. I think I know the answer to the next question already from the conversations we've had so far, but the retracement, do you see it, given that we are the bull run that started and just how strongly we moved, do you see the current situation or the current retracement as healthy and short term? Or as again, this has been suggested from an audience member, is the bull market over and are we in bear territory? Which, we all know the answer to that, but I'm going to ask the question anyway. So is the retracement normal and healthy? And is there more to run? And I guess, given we know the answer, how much more to run do we believe?
So again, our fair value calculation for Bitcoin is currently at $35,000. And to learn more about our valuation models, please feel free to visit our website, swissrexag.com, where we have more reports on how we value something like Bitcoin. So therefore, we are currently exposed with a net exposure of 50% because we are at more or less at our fair value target right now. We think for the next 3 to 6 months, there will be consolidation in the market, sideways movement, which means a plus or minus 20% should be possible. But in the longer term, we are very positive for the crypto market. Right now, we just see that, for example, the whole regulation topic makes people nervous and creates insecurity.
I'll touch on that. There's a question later on regulation, so we'll keep that to one side for now. Jeff, do you have anything to add?
Yeah, I mean, first of all, we have to figure out the definition of a bear market, right? When in equities, we say a bear market is a 20% move. If that's the case, I think we get a bear market every hour and a half right now in digital assets. I mean, it's the volatility has been incredibly high. So is it normal? Whether that's good or bad, I think we've all become a little bit immune to these kind of swings because we've seen it now for 5+ years. Is it healthy? I think the leverage. The deleveraging that we saw is very healthy, right? I mean, we saw futures, open interest on futures fall from, I think, 50 billion down to 20 billion during this move lower. We've seen the exuberance in yields and rates fall. I think spot futures arbitrage went from 40% annualized to now like 2% annualized, right? So the deleveraging is healthy. In terms of, is it healthy to see 50% drawdowns across the market? I mean, I don't think anybody wishes that, nor is that a healthy long-term environment. But I think it is, you are starting to see some green shoots again, right? You're seeing different sectors that are starting to do well at the expense of others. And, that part is healthy. Why do we consider healthcare and utility stocks defensive, right? Why do we think of treasury bonds as defensive? Well, there's, decades of history that shows that they are, in some ways negatively correlated, or at least, low correlated to the rest of the market. We now have pockets of digital assets that look like that as well. In any 2-week span, correlation might go to 1, but over 3 months, 6 months, 9 months, 12 months, you do see, uncorrelated and even some negatively correlated assets. I would argue that there's a common narrative that rolling into Bitcoin is a defensive trade. Intuitively, that makes no sense to me, right? Most defensive trades are things with cash flows and yields. Bitcoin doesn't have that. DeFi has that, right? DeFi has real revenues and real yields and real cash flows. Some of the gaming tokens have that. And I think the market is starting to respond to that a little bit. It might take time before you have a real rotation. When I was on the, distressed and high yield desks, right, you would see guys like Carl Icahn who weren't involved in debt for 8 years. All of a sudden, the market gets dicey, and he rotates out of equities into debt. Right? You see high yield guys will roll into converts when the converts get busted. You don't have that natural rotation yet in digital assets because, it's not as easy to move money from debt and equities and real estate into digital assets. But I think you'll get there soon. I think you'll see some rotation, right? Kathy Wood at ARK Invest is a good example of that, right? She's rolling some of her portfolio into Coinbase and into Bitcoin right now because it's been disproportionately beaten up versus other tech opportunities. But we don't see a lot of that yet. So over time, I think these drawdowns will be less when you start to see natural rotation buyers come in. And that just takes time, right? I mean, it was only, 4 weeks ago that JP Morgan wrote a piece about DeFi, right? We saw Nexus Mutual, one of our favorite decentralized insurance companies, has been written up by Goldman, Piper Sandler, and BTIG in the last few weeks. So you're starting to see a little bit of that, and that will over time will reduce some of these large drawdowns that we've become fairly used to.
Yeah, I guess if you vol adjust equity markets for crypto, I guess a bear market in our space is a 90% drawdown. If 20% is traditional, if all adjusted, we're about at 90%. But the reality is that we're still in a range. Like we're still in a bullish pattern. Range bound markets are fine if you can capitalize on them either by directional trading or, for example, we just, acqui-hired a group for market neutral strategies, which, tend to benefit in range bound markets that also have volatility. So range bound no vol, it's not going to be a great strategy to be in. You're probably going to yield next to nothing, but range bound with volatility end up generating some interesting return streams that don't depend on directional exposure. But I agree. I think dispersion is one of the key kind of pieces of the market in 2021 that we really never saw previously. We saw kind of bits of it in 2020, but there's proper dispersion in the market in 2021. And I think shows the maturation of the market and identifying assets that are, whether it be cash flow generating, revenue generating, or otherwise, right? There's a way to actually model these assets. I'm sure any of us talk to our old friends in trading desks or investment firms. They're entering the market in assets they think actually have value. So I do think that's a very kind of key thing. And to be frank, I mean, all of us as active fund managers, that is something we want the market to have. We don't want everything to be some function of Bitcoin beta. We want dispersion in the markets because that's, where we can tap into our expertise. So it's a very positive and healthy piece of the market. And, and whether we're not in a bullish, bearish or neutral regime, and, we're certainly, we held a second close in a kind of emerging DeFi vehicle that we have more recently to take advantage of depressed markets. So we clearly think that we're in a bit of a retracement period, but long-term, excellent period to be deploying.
Excellent. Just on that then, can I ask each of you for a very simple yes or no, will we see record highs before year end?
Jeff's going to ask for clarification.
Yeah, I was going to say, I can't. I do not think we will see record highs in Bitcoin. I do think we'll see record highs in many other assets.
Okay, good answer. Desiree?
No.
Okay, Michael?
I'm in Jeff's camp, which is, it's we will in particular assets. Yes, I'll leave it at that.
Okay. So then, as fund managers, I will leave with you here, Jeff, because you've already mentioned this in answer to the previous question, is during the initial run, did you manage to take some profits pre-correction? And if so, what are you doing with that capital? Have you redeployed that capital already? Are you watching the market sat on the sideline with that capital? Or are you planning to take further profits? So I'll start with you, Jeff. I think you mentioned earlier about taking profits pre-correction.
Yeah, I mean, the way we run our models and our risk models is we're almost always taking profits into strength. All else equal, if there's no news and no change in a company's fundamentals, when prices go higher, we're sellers. When prices go lower, we're buyers. So, during basically from beginning of the year through, middle of May, we were taking profits along the way. We also, one of the nice things from an active management standpoint in this asset class is that on the way up and during stable markets, assets are very uncorrelated, but on the way down, they become very correlated. So it leads to very natural hedging. So we do a lot of buying puts in Bitcoin and Ethereum. So we actually did really well in May because we were invested, across our other sectors, and we're taking profits and had a high cash balance, and we had heavy puts. So during like the initial flash crashes, we did great. Then we started deploying capital throughout June and through July, because again, we are fairly, mostly bullish on the assets in the sectors that we're mostly invested in. We've deployed, not super aggressively, but we've almost fully deployed over the last 6 weeks here. We treat it a lot like a distressed environment where, again, having been a high yield bond a trader for a long time, right? If you're buying a bond that you think is worth par and it falls to 50 cents on the dollar, well, that's great. But if it then goes to 30 cents on the dollar, you're still down, 40%. But you think it's worth par, so it doesn't really matter at the end of the day if you bought it at 50 or 40 or 30. That's kind of the way we think about it. Is we want to avoid those huge blowups. We want to avoid those huge leverage drawdowns. Once it sort of gets to fair value, in our opinion, where it's really good value, timing it is impossible. So we just continue to deploy capital in the best assets along the downtrade here.
Excellent. Desiree?
So in May, we only lost 0.7%, while Bitcoin lost around 37% calculated in Swiss francs in May. And right now we are only positioned with a net exposure of 50% because we think Bitcoin is fairly valued. And we are waiting for opportunities to increase our exposure in the DeFi space again, where we see very interesting developments. And currently we are actually shorting a couple of payment tokens because we think this concept will be overruled or taken over by stable coins. So currently cautiously positioned, we think it could be that there is another correction, which we then would use to increase our exposure. And if the market goes up a lot now, we will miss out on the first part and then cover our positions again. We think we can do this because we are up 245% year to date net of fees, while compared to Bitcoin has made around 22% in the same period of time.
Michael?
Yeah, I think Jeff brought up a good point around optionality and gamma in a portfolio, particularly in an asset class like cryptocurrency, where it's very momentum oriented. And so in the ups, you organically grow longer if you're long gamma, and in the downs, you organically grow shorter. And as the market moves lower, so that does help in terms of risk management, broadly speaking. The ability now to transact in the option space is extremely beneficial from a risk construction and a risk management standpoint. So you can be extremely comfortable. For example, early in the year when there were clearly identifiable buy patterns, you literally could see the TWAP come in every single day on Coinbase when MicroStrategy or Tesla was coming into the market, and it was a clear buy signal. You can have comfort in being notionally levered, right? This is not cash basis leverage; it's notional leverage from an options portfolio, because the market was so kind of transparent. As risk entered the market, if you did not delta hedge and reduce risk, there's just effectively no risk management process whatsoever. So yes, I think all of us here took profits along the way, particularly as the market got continuously more levered. We felt the need to continue to cut further. I can't talk about portfolio specifics, but I think all of us here saw that, felt that, and yeah, I mean, have redeployed over the course of the last, call it 4 to 6 weeks. No one gets the tops right. No one gets the bottoms right. Sounds like, Desiree, you guys did a pretty damn good job of it. But, for us, it's there's also the function of execution and hedging out portions of the portfolio without taking massive slippage in the names that you own. So, it's always an interesting task. But I do think that the growth of the market structure, particularly in options, is very helpful from an asset manager's perspective.
Okay, I've got a question here surrounding it, which has just led me on to I was going to touch this a little bit later on, but it flows nicely from where we are with the conversation, talking about maybe not being so Bitcoin centric and coming away from Bitcoin and other sectors within the class, whether it be DeFi, NFTs, and differing projects within. What areas or projects within the digital asset space do you feel offer the greatest potential for gains? I mean, Jeff, you said Bitcoin record high, no. Other tokens, yes. Or other areas, yes. So maybe we can expand on that. Which are all these other areas that we are seeing the positivity around?
Sure. Well, I mean, I'll expand on DeFi, right? Because even DeFi itself now has subsectors, and it's not all the same. So I think we are incredibly bullish on decentralized exchanges, Uniswap, SushiSwap, even PancakeSwap on the Binance Smart Chain, in the sense that overall trading of digital assets, decentralized exchanges used to represent 1% of overall volumes. Now they're up to 16% of overall volumes. That's happened in the last year. That's a huge move away from some of these centralized counterparts to the decentralized exchanges. And you're going to continue to see more of it because this regulatory pressure is unilaterally being focused on, your centralized exchanges. Whether it's Binance or from a regulatory standpoint, or even just the hiccups we see from a latency standpoint at Coinbase and Kraken and everywhere else every time there's a market drawdown. There's reasons that people are excited about trading on decentralized exchanges. We're also really bullish on insurance within DeFi. Nexus Mutual is one of our biggest positions. If you haven't checked out Nexus Mutual, it's trading at 1 times book value versus call it 10 to 40 times book value for other insure tech companies like Root and Lemonade. It makes no sense. It's the most mispriced thing in the market. We use it as a fund, and we see, you could track on Twitter. There's something called Nexus Mutual Bot. It's just fires away nonstop with all the people who are actively engaging, buying and selling insurance on this platform. And unlike, Root and Lemonade that have 400 employees, Nexus Mutual has 9. Right, so you can see where the cost savings come in when you're decentralizing some of the basic functions that have traditionally been done by humans in finance. Away from that, we still are really interested in sports and gaming. 2 different things, but we lump them together a little bit. So I mentioned Axie Infinity already in gaming, but we think there are some other gaming assets coming that have figured out this way to turn sweat equity into real equity. For anyone who has traditionally been a gamer, or has children who are gamers. I'm not personally, but you spend a tremendous amount of time and energy playing a game, and then when you no longer want to play the game, it's all gone. Well, now with blockchain assets that you can own within the game, that time you spend is not lost when you get a new version of the game or you decide to not play the game anymore. And these companies are figuring out how to reward their players for that sweat equity. Similarly in sports, Chili's, CHZ is still one of our bigger positions. This is a company that started with partnerships with just English Premier League, with Juventus and FC Barcelona and Man City. Now they have a deal with the Celtics and the 76ers in the NBA. They have a deal with the New Jersey Devils. They have a deal with the UFC and an Indian cricket league. This is, all they're doing is giving fans what they want, which is a quasi equity stake and a governance stake in their favorite teams. This is a massive use case for blockchain, and to us, one of the cheapest assets in the market still today. So we think, pockets like that, sports, gaming, NFTs, DeFi, there's going to be tremendous winners that have nothing to do with Bitcoin's success or failure.
That's the answer. Anyone, anything to add?
Yeah, we are also focused on security tokens currently. We really like tokens that generate cash flow because it gives us the opportunity to value them with traditional valuation methods like PE ratios, for example. And we really like decentralized exchanges like Sushi, where we calculate the dividend yield of 10% for this year, or decentralized banks like Synthetix, where we even calculate a dividend yield of around 20% for this year. So we also focus on the decentralized finance space right now.
Yeah, I think you both nailed it. The only thing outside of that is just catalyst-driven trades that have effects on certain industries more than others. So, Arbitrum, for example, is cross-chain layer 2 that's launching. It's probably one of the biggest events for DeFi this summer. So just orienting the themes around the events and catalysts, I think, is an important piece of this. If you're able to trade that well, there'll be some outsized returns in doing that as well. That's kind of the way to think through it. And then it's just the impacted parties. So it's the second order effects beyond the event itself. But really, functionally, what Desiree and Jeff went through are kind of the key themes.
As asset manager, we've been advocates of diversification from day one. I mean, it's our ethos: diversification, due diligence, And I think from that question and the excellent answers given, it clearly evidences to anybody the diversification that does exist within this asset class. People see a niche asset class and then they think, therefore, there's no diversification within. You know, they're holding digital assets, or in many people's eyes, they're holding Bitcoin and Ethereum. But the fact of the matter is that this diverse universe that is so broad, once you go down the digital assets rabbit hole, it's, you know, I'm still learning every day, and we'll continue to do so. And it is so very diverse. And I'm sure many of the people listening in will just be starting their digital assets journey, and they're probably coming across names and tokens and sectors that they didn't even know existed. So again, it's great because it really does show and evidence the need for diversification. So just back to the questions. The market, we've typically seen these 4-year cycles. Okay, the asset class is 12 years old. Bitcoin is 12 years old. The asset class that now we find ourselves in, it is obviously newer than that by way of when funds were launching and it becomes sort of investable asset class. But looking at the cycles, what are our thoughts on the market being so cyclical as it has been since its start? Do we believe that the market will remain as cyclical, or are we going to start to see that change? So I'll just put that out there.
I think it will get less cyclical with every cycle we go through. Actually, it will mature. And I also think right now there are still a lot of returns to be made in this space because there is still a lot of uncertainty with regards to regulation. There is still a lot of volatility. But once this is all clear and volatility is much slower and regulation is very clear, it will not be the same options or opportunities for creating returns in this space. So this is why I think it absolutely makes sense to allocate part of the portfolio to the crypto space. And then the question is just how much do I want to allocate and with which product? Do I want to go with a fund of funds? Do I want to try to allocate money myself with a wallet and go to the exchanges or any other diversified product?
Michael?
Yeah, we'll continue to have cycles. Whether it'll continue within that 4-year band is to be determined. I think the cycles will be less apparent just given the market is maturing and things like the options market, derivatives market more broadly is exploding. Allows for it acts as more of a buffer for these types of dramatic drawdowns. So we still have, you know, the asset class is still 100 implied vol asset class, which is kind of crazy to think about in the context of, you know, the S&P at, you know, 15 to 20. That'll continue to come down over time. I think, again, it's a function of this regulatory sandbox creates the opportunity. And by the time scale comes in and a lot of those, you know, those unknowns become known, I think the opportunity set does decline slightly, but that's kind of when you continue to advance in other parts of the industry is, you know, some of the stuff that Jeff and Desiree had mentioned where there is, you know, specialization is still very critical, and understanding market structure, understanding DeFi engineering becomes kind of mission critical to extending your moat. But yeah, I think, you know, we'll continue to be cyclical. It's a volatile asset class, and the broader macro, you know, market, even though a lot of the risks in crypto are orthogonal to most other things, there is always some impact in liquid capital markets, regardless of the asset class when we have a volatile macro environment.
Excellent. Anything to add, Jeff?
Yeah, I mean, look, investing is 90% narrative, regardless of what asset class you're in, right? So the narratives in equities and debt have been built since Graham and Dodd in 1920 and Frank Fabozzi since 1965. And, you know, that just becomes known that there are certain cyclical and non-cyclical sectors. There are certain ways to value these assets, and therefore some are going to be, you know, more or sort of less exposed to a market downturn. You know, these narratives just haven't been built in digital assets yet. So we are constantly just assuming that the past is going to be the future. And obviously that's not going to be true, right? We're going to see pockets of digital assets that differ from others over time. We're going to see valuation techniques that ultimately become standardized. And as that happens, then that will take some of that cyclicality out of the entire market. I don't know when we get there. You know, from a profitability standpoint, part of the alpha for, you know, all three of us on here, or all four of us on here, is coming from the fact that there is, you know, this high volatility. You know, it's not necessarily a great thing when that volatility dies, but it inevitably will, because you will start to have patterns and stories that people tell that drive the way people invest. So I think, again, Bitcoin specifically probably has to be cyclical, right? I mean, this is the narrative around halvings and every 4 years is probably not going to go away. But for everything else, it's fairly brand new. I mean, you can make an argument that most digital assets from companies, not from decentralized entities, in theory should be recession proof. Because most digital assets are really some sort of a hybrid between a quasi equity and like a quasi loyalty or rewards card. So your equity, that obviously will be exposed to GDP and market downturns, but your loyalty cards don't really change, right? If you're a passionate Starbucks or Target customer, you don't become less of a customer during a recession. You still are passionate about that company and that brand. And if you have $100 gift card, that $100 gift card doesn't lose value during a recession. A lot of digital assets has that sort of loyalty reward type attribute that in theory doesn't go away, and then sometimes even strengthens through recessions. So I think once these narratives start to become more well known, and once the revenues and cash flows of these companies start to become more well known, I think a lot of those preconceived notions and historical patterns will start to dissipate.
So do you think therefore we'll see a decoupling from Bitcoin kind of being a bit like the tide leading the digital assets, with waiting for Bitcoin to move one way or the other and pulling the market or pushing the market? Do you think we'll see a decoupling of that influence?
I mean, I think you're already seeing it, right? Bitcoin's up 17% year to date, and just about everything we own is up 100 to 500% year to date. I mean, I don't know how much more proof you need that it is decoupling. Again, in periods of stress, sure, the correlation rises. But again, over longer periods of time, the correlations and betas have been going down for 4 years. Again, I like the fact that they get super highly correlated during periods of stress. It makes my job really easy from a hedging standpoint. But I don't think it's going to be the future, right? I mean, it makes no sense to assume that every digital asset is the same just because they're all digital assets, right? In the same way that you wouldn't think of a healthcare ETF and a gold ETF and a treasury bond ETF as all being the same just because they're all packaged inside of an ETF wrapper. The same thing is true of digital assets, right? Bitcoin is a decentralized global, whatever it is, store of value currency, right? Ethereum is a platform more akin to the iOS app store than anything else. Chili's and Axie, which I mentioned earlier, or Sushi Swap, which Desiree mentioned, these all have completely different drivers of success and failure that have nothing to do with other digital assets just because they're all packaged into that same box. So yeah, I think it's inevitable that you will start to see differentiation and decoupling.
Excellent. I was playing devil's advocate a bit there, but it's a great reply and just what I expected. Just the last couple of questions really to finish then, and I'm going to focus on two things really: regulation and risk. We've talked about them. They've came up in a couple of answers. Let's start with regulation. It's a bit vague, to say the least, in this industry, and it obviously differs from country to country. It's obviously coming, and it is here to a degree. Is the current situation, I know it's far from ideal, what are your thoughts as managers in the space on where regulation is currently, how it's going to change going forward, and is that a positive or a hindrance? I open with you, Michael.
Yeah, regulatory risk is one of the kind of outstanding tail risks of the industry. Tail, I say tail because it's agnostic. It could be a left tail or a right tail. I think either way, something to keep on top of. What we've come to notice, and we keep a lot of folks from at least the US regulatory side close to our firm, for context, is because we want to understand the language that's coming out, the language being proposed, and how impactful and realistic it is in the near term. And I think Jeff, I think it mentioned earlier about kind of the duration of when this will impact the industry. And reality is we've had a number of, I think positive commentary come out of different parts of government around, the Office of the Comptroller, for example. We also had some negative commentary come out around areas like DeFi, but that was sort of worked with the industry. So I think the collaboration between industry and government, lobbyists and government is becoming a lot stronger. That being said, no regulator at this point, at least according to the folks that we speak with on the US side, no regulator really wants to take ownership of this at this point. There's a lot other, there's a handful of other priorities that they need to focus on in the interim. which is fine. I think for all of us here, that's, again, that just kind of extends the regulatory moat that we all have in operating the industry and taking those risks. And without taking kind of outlier risks, you don't necessarily have the opportunity for these unusual types of returns and rewards. So regulation will usher in a whole new sort of environment, new market participants, new market structure. Some incumbents will win, others will lose, and that's kind of, we have to play with that as dynamically as the environment is, which is, it's an unknown, which makes it all the more fun, I think, in our eyes.
Perfect. Desiree, you mentioned regulation yourself when answering a question earlier on. Your thoughts?
So I think there are some positive developments. For example, here in Switzerland, we have the first 2 full crypto banks with a full banking license. We can use them as custodians, which is really great development. And it shows us that this is probably not going to disappear anymore. On the other hand, it will be interesting to see how the entire DeFi space will be regulated. I mean, these are decentralized projects, pure software. There is no headquarter anymore. There is no CEO. So it's really going to be difficult for the regulator to step in. Of course, money that is coming from these projects could be blacklisted, for example, which will make access quite difficult. And probably in the end, there is going to be some real DeFi projects that just do whatever they want to do, and the regulator cannot step in. And some that will try to include KYC, AML standards in their standard procedure, just as banks ask for it. But in the end, new technologies are always tough for the incumbents. I mean, a long time ago, the telecom providers also tried to prevent WhatsApp from happening. And I guess for banks and insurance providers of today, this is going to be really disruptive, and this also creates a lot of fear.
Excellent. Jeff?
Yeah, I mean, the irony here is it's the opposite of traditional markets, right? The traditional markets, the companies themselves blow up all the time, but the regulators have your back and the governments are going to bail you out. Here, the assets are doing great, but we have this constant regulatory overhang that is just a cloud that won't go away. We're pro-regulation. We think regulation should and will happen. And ultimately, when you do see negative headlines, it'll probably be short-term, and long-term, you'll be higher as a result of more investors getting comfortable because of the regulation. But I think the most important thing that people need to understand is that, yes, regulators are watching the digital asset ecosystem, but there's no statutory authority for the CFTC or the SEC or any other regulatory body right now to do anything, right? Congress has to pass bills and laws to change who oversees this, and that is not happening anytime soon. So, I think it is great clickbait for the media. It's great headlines. It's great for algo-driven models that trade on headlines, but there's nothing to it right now. I mean, you physically can't get regulation until we have laws passed, and that's just not even on anyone's agenda right now. So
I agree. I mean, even in the U.S., we've had Coinbase lists. Circle now is going to de-SPAC into a public entity. I mean, the fact they're allowing these companies to go into public markets in the U.S. that are entirely premised and based in the cryptocurrency space, if they do anything to inhibit the market and retail investors that own, like the CFPB will be all over it, right? Like this is just most of the Coinbase ownership, I would say most, but a fair amount of Coinbase ownership now is in the hands of consumers. There's a direct listing. Most of the VCs sold, a lot of VCs sold out, a lot of institutional investment managers sold out of it. It's in the hands of people that want to own some form of levered cryptocurrency exposure in the equity markets and some other ETFs and others. Like it just, it's kind of, what Jeff's saying is I agree. It's going to take a while for Congress to pass bills to get this sorted out as to who actually owns oversight of it. But in the interim, they're just de-risking this more and more because more companies are coming public. They're interacting with traditional capital markets. It's going to be much more difficult for them in a few years' time when we have 36 public companies in the crypto space that are now free floating and in mutual fund companies of Mr. and Mrs. Johnson in the U.S.
Excellent. I'm going to go a little bit more deeper now. If regulation is a bit of a vague area, taxation. What are our thoughts on taxation? Is this the biggest risk to digital assets? I mean, it's even more vague than regulation. So I just wondered to close off, what thoughts are with regards to taxation and its impact and risk to digital assets?
The U.S. is good at getting its money.
Yeah.
Yeah.
It's coming.
I mean, look, myself and my team, we're fundamental analysts, right? We know how to value companies and sectors and themes and projects. We don't have any skill set in terms of managing tax and regulatory risk, right? It is just constant tape bomb after tape bomb, both good and bad. And ultimately, it doesn't mean anything for the underlying assets. So I don't have a strong opinion. Fortunately at ARCA, we have one of our managing directors used to run a Washington policy research firm before, being elsewhere in fintech and ultimately digital assets. So we get a lot of color from regulatory bodies and accounting bodies with regard to what they're thinking. But again, I'll just reiterate, they're nowhere close to anything happening right now. So, you can read every headline until you're blue in the face. It means nothing. It's political posturing until there's actually a regulatory body that has actual oversight here.
Yeah, it's difficult and somewhat painful. I mean, even in our space, we basically just take the most conservative approach, right? Like we didn't interact with we owned DeFi assets. We didn't interact with the ecosystem. We weren't yield farming because we weren't sure for an extended period of time whether or not it was create UBTI or ECI for investors in the fund, and that is a pretty significant tax implication for underlying investors. So until we got clarity from our external auditor, a third-party advisor, and another external service provider that we use that took many, many months to get comfortable with, only then were we comfortable actually interacting with this ecosystem, yield farming, and then relaying that to our investor base of this may or may not, this is our view, but you should consult your own sort of tax advisor on whether or not this creates a taxable event for you. So and because the market matures and changes at such a rapid pace, it's just constantly trying to stay above water on that. But it is really difficult to do so. I assume all of us take the most conservative approach, and just kind of try and work alongside, sort of do your best work in bringing in external third parties to advise as well. It's just it's a like I said, it's a gift and a curse, this industry.
Howard, Desiree, anything to add?
Yeah, in our case, most investors are Swiss, and therefore we have a Swiss lawyer who does the tax reporting for us for Swiss buyers or investors. Excellent. So we differentiate among income and capital gain. That's what we basically do.
I love the simplicity of the Swiss financial system.
Simple and efficient. It works. It works. I guess then closing words really. I'd like just to ask each of you, just for the audience, when it comes to investing in digital assets, do you have any words of advice for those that are just making their way and starting their journey in investing in digital assets?
I would say be curious, try yourself to analyze these tokens, to buy them and to store them safely. And in case you find out that it's really tough to time the market or to store these tokens, then decide for a professional fund where you can put your money in. And I think there are a couple of possibilities or a couple of names you could look at after today's webinar or panel.
Definitely. Jeff?
I would say, first and foremost, use LinkedIn and not Twitter when you're vetting who is telling you something. But aside from that, I think, erasing your mind and just starting over is honestly the best way, because this asset class has evolved so much in the last year, 3 years, 5 years, that most preconceived notions need to basically be erased, and you need to come at this from a fresh angle. And when you do that, and you're not biased by what you think you know, and you start to look at what this asset class really has become, it's pretty amazing how far we've come and how attractive some of these investment opportunities really are.
Very wise words. Michael?
Yeah, just take the long view. Don't feel rushed into it. Do your own research. There's an enormous amount of materials and content that is available now. Again, I think that's a very good word of advice from Jeff. Background check on LinkedIn versus Twitter is probably a good rule of thumb. but yeah, I mean, look at it with a long-term lens. I tell all of my family and friends that aren't institutional investors, just, think about it. What do you want to allocate to the space over time? Dollar cost averaging is the least anxious, rich way to invest in the space. So, and honestly, the tailwinds are here. So it's more about avoiding the losers. I've heard a lot of really sad stories about people that have had deals come to them, and it's kind of the way I view every other market outside of crypto. If something's coming to me, it probably didn't make the cut with the people that matter. And so, generally speaking, be very careful, be very skeptical, ask a lot of questions, and interact with it. I think that was right. Desiree made a good point of buying, interacting with these assets, doing it safely with a safe amount of capital, and have the long view on it.
Yeah, to that point, I would just add too, because as Michael made a great point there, is we get asked almost every time on an investor call, whether it's a new or existing LP, like, is now a good time to add? And the reality is, we take monthly subscriptions and monthly redemptions. This asset class can change from incredibly attractive to not attractive much faster than you can allocate. And trying to time entry points is really a fool's errand. So, having a long view, but also trusting in the process and the manager that you're working with matters a lot more than trying to time, these volatile market conditions.
Excellent. I think it's a great point. Just to close off and finish on that, for the audience wise, I'm sure everyone will agree, 3 expert panelists and some very, very, some excellent answers to the questions put there. I'd like to say from Block Asset Management's point of view, again, due diligence, diversification, and as each of the managers rightly said, you need to do your research. And on that note, each of the managers that's spoken, their contact details will be available. They all have their LinkedIn profiles. If anybody would like to reach out to the panelists directly, they can do so, come through Block Asset Management, or they can find them online. And yeah, they're very knowledgeable. And as managers, we allocate to these funds. They are excellent managers, excellent selections within our portfolio. And we love to work with the team. So feel free to reach out to each manager directly or through Block Asset Management. We can do that. I will say as well, Jeff, that he has a great article that goes out on both LinkedIn and I think in the rest of social media called Our Two Satoshis, which is a view on the marketplace, which I find an excellent read when it comes out. And it's something that's on our reading list as a company. So yeah, great work on that and keep it up. And I'd suggest anybody, if they're on LinkedIn, to hook up with the 3 panelists and read the articles that are regularly put out there by knowledgeable people in this space, which is what they are. So it just leaves me to say a thank you to the 3 panelists, Desiree, Michael, Jeff. Thank you very much for your time. As always, greatly appreciated. Great content, great feedback. And yes, thanks for your time. And I'm sure I'm thanking you on behalf of all the attendees as well. Until the next time, thank you very much and enjoy the rest of your day.
Thank you.
Thanks, everyone.
Thanks, guys. Take care. Bye-bye.